night and day before and after 20th September, isn't it, Neeraj? But the bottom line remains that the market looks like a broad-based one for the last couple of days or for the last 3-4 days, but it's going to get very selective, quite narrow, and the same 50, 70, 80 names are going to perform. And that is the problem because most guys are not invested on those kind of companies, and they still start trying to average around the small caps, the mid caps, the beaten down, the throwaways, and the garbage stocks. But I don't think there's any future in them. Everything is in a bubble. Everything is in a bull market since 2009 because so much of money has been printed. Commodities in a bull market. Economies are in a bubble. So why shouldn't stocks be in a bubble? But the difference in stocks being in a bubble is a bubble will always be found where there is some fundamental attribute. We formed a bubble in Infosys, we formed a bubble in L&T, we formed a bubble in ACC in 1992. There were certain attributes to those kind of companies, and those kind of companies survived the bubble. I'm not saying I'm very happy owning stocks at 100p or 70p or 60p, but I'm really happy making money for myself and for my investors. Except for those handful of companies, I don't see anything else doing well, not because we own those kind of companies, but because in a 5% GDP growth, you cannot assume 5,000 companies to be doing well. So that's the problem. If you can assure me, or if I can assure you that the GDP growth would be 7.5% for next financial year onwards, then I'd become very bullish on the small caps, the mid caps, the beaten down, the downtrodden, the throwaways. But if you have 5% GDP growth, it's like small children competing with a big bully and saying, I want my share of the pizza. The big bully is going to keep everything for himself. The children won't get anything.